I've watched people throw their money away for decades, and I've noticed something troubling. Wealth isn't only built by what you earn, it's built by what you keep, and more importantly, by what you refuse to buy. I've seen doctors making $500,000 a year living paycheck to paycheck. I've watched tech entrepreneurs with seven-figure exits go broke within 5 years. The pattern's always the same. They're making six purchases that mathematically guarantee they'll never build real wealth. And the tragedy is they think they're making smart decisions. Let me be clear about something. There are six categories of purchases that, from a pure data perspective, represent some of the worst financial decisions you can make. These aren't just bad investments. They're systematic wealth destruction machines, and most people are feeding them every single day without realizing the compound effect over a lifetime. The problem isn't that people are stupid. The problem is that they're emotional. They buy based on how something makes them feel, not on what the mathematics tell them. They follow social signals instead of probability distributions. They optimize for short-term satisfaction instead of long-term value creation. This is exactly the opposite of how successful quantitative investors think. We strip away the narrative. We ignore the story. We look only at the numbers. And the numbers on these six purchases are absolutely brutal. Let me start with something that might surprise you. Brand new luxury cars. Now, I know what you're thinking. Everyone already knows cars depreciate. But let me show you the actual mathematics, because once you see the numbers, you'll understand why this is one of the most devastating financial mistakes people make repeatedly throughout their lives. Here's what happens. The moment you drive a new luxury car off the dealership lot, it loses approximately 20 to 30% of its value instantly. Not over time, instantly. You're paying $100,000 for something that's worth $70,000 before you've driven it a single mile. Now, let's run this through a simple expected value calculation. If you took that same $100,000 and invested it in a diversified portfolio with a conservative 7% annual return, in 10 years, you'd have about $200,000. But the car? In 10 years, that $100,000 car is worth maybe $20,000 if you're lucky. You've lost $80,000 in real value. Plus, you've lost the opportunity cost of what that money could have generated. The total cost of that purchase isn't $100,000. It's closer to $250,000 when you account for lost investment returns over a decade. I've never understood the psychology behind this. You're taking a depreciating asset, something that loses value every single day you own it, and you're treating it like it's an investment in yourself. It's not. It's pure consumption dressed up as success. And here's what makes it even worse. The maintenance, the insurance, the premium fuel, all of these costs scale with the price of the vehicle. You're not just losing money on the purchase, you're losing money every single month you own it. When I was building my career, I drove modest cars. Not because I couldn't afford better. I could have bought any car I wanted. But because I understood that every dollar I spent on a depreciating asset was a dollar that couldn't compound. And compounding is the most powerful force in wealth creation. It's not linear. It's exponential. Every dollar you save in your 30s is worth $16 by the time you retire if you invest it properly. Every dollar you waste on a luxury car is $16 you'll never have. Multiply that by 100,000 and you start to see the real cost. Now, some people argue that luxury cars provide utility. They're more comfortable, safer, more reliable. And there's some truth to that. But here's the key insight from quantitative analysis. The marginal utility curve flattens dramatically after about $30,000. A $30,000 car gets you 95% of the utility of a $100,000 car, but it costs 70% less. You're paying an enormous premium for a tiny increase in actual benefit. That's not rational. That's emotional decision-making masquerading as rational choice. The better approach, the mathematical approach, is simple. Buy a 3 to 5-year-old car from a reliable manufacturer. Let someone else absorb that initial depreciation hit. You get essentially the same utility for a fraction of the cost. Then take the money you saved, the $70,000 in this example, and invest it in assets that appreciate rather than depreciate. That's how you build wealth. Not by driving wealth, by owning wealth. But here's where it gets really interesting. The second thing you need to stop buying, and this one's going to make some people uncomfortable, is an oversized luxury house. Now, notice I said luxury house, not a house. Housing can be a reasonable investment under certain conditions. But what I'm talking about is the house that's twice as big as you need, in the most expensive neighborhood you can barely afford, with property taxes and maintenance costs that eat up a significant portion of your income every single year. Let me give you the mathematical breakdown, because this is where people really fool themselves. They think they're building equity, and technically they are. But they're ignoring all the hidden costs that make this one of the worst investments most people ever make. First, there's the opportunity cost. Let's say you buy $1 million house when you could have bought a $500,000 house that meets all your actual needs. You've got an extra 500,000 tied up in real estate. That's 500,000. That can't be invested in higher returning assets. Over 30 years in the stock market, that would have grown to about $4 million, but it's locked in your house. Second, the carrying costs scale with the home value. Property taxes on $1 million home might be $15,000 a year. On a $500,000 home, it's half that. Maintenance costs about 1 to 2% of home value annually. Insurance, utilities, landscaping, repairs, all of these scale up. You're spending an extra $20,000 to $30,000 every single year just to maintain the larger house. That's money that's gone forever. It doesn't build equity. It just evaporates. Third, and this is what people really don't want to hear, large houses don't appreciate faster than smaller houses in the same area. The appreciation rate is tied to the local real estate market, not to the size of your house. If the neighborhood goes up 3% a year, your $1 million house and the $500,000 house next door both go up 3%. The absolute dollar gain is higher on the expensive house, but the return on investment is the same, except you've had higher carrying costs the entire time, which means your actual return is lower. I learned this lesson early in my career by watching what happened to my colleagues. The ones who bought the biggest houses they could afford, they ended up house poor. They had this impressive asset on paper, but no liquidity, no flexibility, no money to invest in actual opportunities. When the market crashed in 2008, they couldn't take advantage of the buying opportunities because all their capital was trapped in real estate. Meanwhile, the colleagues who lived modestly, who bought smaller houses and kept their money liquid, they could buy stocks at 40% discounts. They could invest in distressed properties. They could take risks that paid off enormously. The difference in net worth 20 years later was staggering. Here's the principle. Your house should be comfortable and functional, but it should not be an ego purchase. The moment you're buying a house to impress other people, you've already lost. You're making an emotional decision, not a mathematical one. And emotional decisions in finance are how you destroy wealth over time. Buy the house you need, not the house you want to show off. Invest the difference in assets that actually generate returns. Now, let's talk about something that seems small, but compounds into something massive. Daily convenience purchases, the expensive coffee, the takeout lunch, the food delivery services. These are the expenses that people dismiss as insignificant, and that's exactly why they're so dangerous. They're small enough that you don't feel the pain of each purchase, but they happen frequently enough that they add up to enormous amounts over a lifetime. Let me give you the calculation, because this is where the mathematics become really striking. Let's say you spend $6 on coffee every workday. That's $30 a week, about $1,500 a year. Now, that doesn't sound catastrophic. $1,500 is manageable for most professionals, but here's what people miss. It's not about 1 year. It's about 30 years of working life, and more importantly, it's about what that money could have become if you'd invested it instead of spent it. If you took that $1,500 every year and invested it at a 7% return, after 30 years, you'd have about $140,000. That's just from coffee. Now add in expensive lunches. Let's say you spend $15 on lunch every workday instead of bringing food from home. That's another $75 a week, almost $4,000 a year. Invested over 30 years, that's another $380,000. We're now at over $500,000 lost to convenience food over a career. That's not a rounding error. That's a retirement fund. And here's what makes this particularly insidious. These purchases don't feel significant because they're surrounded by social reinforcement. Everyone at the office is getting the expensive coffee. Everyone's ordering lunch. You're not making a conscious decision to sacrifice your financial future. You're just doing what everyone else is doing. But that's exactly the problem. You're following the herd. And the herd is not building wealth. When I was working on breaking codes for the Department of Defense, and later when I was teaching mathematics at MIT and Harvard, I brought my lunch almost every day. Not because I was cheap, not because I couldn't afford restaurants, but because I understood that small daily expenses compound exponentially over time, and I wanted that compounding working for me, not against me. I wanted every dollar I saved to turn into $16 by the time I retired. And the only way to do that was to be disciplined about the small decisions, because the small decisions happen every single day. The solution here is simple but requires discipline. Make your coffee at home. It costs about 50 cents instead of $6. Bring your lunch. It costs $3 instead of 15. The coffee tastes 90% as good, and the lunch is probably healthier. You're giving up a tiny amount of convenience and maybe a small amount of social interaction for hundreds of thousands of dollars over your lifetime. That's an incredible return on investment for a minimal lifestyle change. But here's where people really fool themselves. They think these purchases are investments in their productivity or their happiness. They tell themselves they're too busy to make coffee, or they need the break to buy lunch, or they deserve the convenience because they work hard. And maybe there's some truth to that. But you need to be honest about the trade-off. You're trading long-term financial security for short-term convenience. You're prioritizing feeling good today over being wealthy tomorrow. And that might be fine if you're making that choice consciously and deliberately, but most people aren't. They're just sleepwalking through these purchases without ever running the numbers. Now, let me talk about the fourth category. And this one is particularly relevant in our current era. Trendy gadgets and electronics you don't actually need. The latest smartphone every year, the tablet and the laptop and the smartwatch and the wireless earbuds and the smart home devices, all of this technology that becomes obsolete before you've even mastered using it. Here's the problem. From a mathematical perspective, technology depreciates faster than almost any other consumer purchase. A $1,000 smartphone is worth maybe $300 after 2 years. A $2,000 laptop is worth $600 after 3 years. And the rate of depreciation is accelerating because the product cycles are getting shorter. Companies are releasing new versions every 12 months, which means the resale value of your current device drops even faster. Now, some technology purchases are absolutely necessary. If you're a professional, you need a reliable computer and a phone. But here's the key insight. The marginal utility of the latest technology is incredibly small compared to technology from 2 or 3 years ago. A 3-year-old smartphone does 98% of what the latest model does for 40% of the cost. You're paying a massive premium to be on the cutting edge. And for what? To have features you'll never use? To impress people who don't care? I've watched this play out in the technology sector for decades. When we were building the trading systems at Renaissance, we didn't use the latest hardware. We used hardware that was proven, reliable, and cost-effective. We squeezed every bit of performance out of our systems through better algorithms, better mathematics, not through better hardware. And that's the lesson. The returns don't come from having the newest toys. They come from using what you have more effectively. Here's the calculation that should scare you. If you're upgrading your phone every 2 years at $1,000 per phone, that's $500 a year. Add in tablets, laptops, smartwatches, and other gadgets, and you're probably spending $1,500 to $2,000 a year on technology that you don't really need. Over 30 years, invested at 7%, that's $240,000. That's $250,000 spent on gadgets that will all be in landfills within a decade. The better approach is to buy technology that meets your needs, not technology that exceeds them. Keep your devices until they actually stop functioning, not until something newer comes out. Resist the artificial product cycles that companies create to drive upgrade revenue, and most importantly, recognize that having the latest technology does not make you more productive or more successful. What makes you successful is how you use the tools you already have. Now we get to the fifth category, and this one is perhaps the most mathematically absurd: lottery tickets and get-rich-quick schemes. Every form of gambling where the expected value is negative, where the odds are stacked against you by design, where you're essentially paying a tax on hope. Let me be very clear about the mathematics here, because this is my area of expertise. Lottery tickets have an expected value of negative 50 cents on the dollar. That means for every dollar you spend, you can expect to get back 50 cents on average. You are guaranteed to lose money over time. It's not a matter of luck or strategy. It's pure probability. The house always wins in the long run because the game is designed to ensure that outcome. I've spent my entire career working with probability distributions, with expected values, with statistical analysis, and I can tell you with absolute certainty that playing the lottery is one of the worst financial decisions you can make. It's not entertainment. It's not a reasonable risk. It's a systematic wealth transfer from people who don't understand mathematics to state governments and lottery operators. But here's what's really tragic. It's not just the direct cost of the lottery tickets. It's the mindset that lottery playing represents. When you buy a lottery ticket, you're saying that you believe wealth comes from luck, from random chance, from hoping that the universe will deliver you a windfall. You're not looking for ways to create value, to build skills, to invest intelligently. You're waiting for magic. And that mindset is toxic to actual wealth creation. The people I've worked with who built real wealth, they didn't get lucky. They worked systematically. They developed expertise. They made calculated bets based on edge and probability. They compounded their returns over decades. There was no magic. There was no luck. There was just discipline, mathematics, and time. And it's not just lottery tickets. It's all the get-rich-quick schemes, the cryptocurrency pump and dumps, the penny stocks, the multi-level marketing schemes, the Forex trading courses. All of these are predicated on the idea that there's a shortcut to wealth, that you can skip the hard work and the discipline and the decades of compounding and just get rich quickly if you find the right secret. But that's not how it works. The people selling you the secret are getting rich. You're the product. Here's the alternative approach. Take the money you would have spent on lottery tickets, let's say $50 a month, and invest it in a low-cost index fund. After 30 years at 7%, you'll have about $60,000. That's not lottery winning money, but it's real money that you built through discipline and compounding. And more importantly, it's money you earned by understanding mathematics rather than hoping for miracles. The lesson here is fundamental. Wealth is not random. It's not luck. It's the inevitable result of making mathematically sound decisions consistently over long periods of time. Every dollar you spend on lottery tickets or get-rich-quick schemes is a dollar you're stealing from your future self, and your future self will not thank you for it. Finally, let's talk about the sixth category: status clothing and fast fashion. The expensive designer brands, the clothes you buy to signal wealth rather than for function or durability. The fast fashion pieces you wear once or twice and then discard. This is another area where people are burning money without realizing the cumulative impact. Here's the economic reality of status clothing. You're not paying for better materials or better construction. Once you get past a certain price point, maybe $100 or $200 for a quality item, you're paying purely for the brand name. You're paying for a logo. A $1,000 designer shirt is not 10 times better than a $100 shirt. It's maybe 5% better in terms of actual quality, and you're paying 900% more for that marginal improvement. And fast fashion is even worse because you're buying clothes that are designed to fall apart. You wear them a few times, they look terrible, you throw them away, and you buy more. The cost per wear is astronomical. You're paying for the temporary high of buying something new, not for actual value. I learned this lesson by watching how actual wealthy people dress. The ones who built their fortunes through business and investing, not through inheritance or luck. They dress well, but they're not covered in logos. They buy quality items that last for years, and they wear them repeatedly. They understand that nobody who matters is impressed by your clothes. The people who are impressed by expensive brands are the people who can't afford them. The people who can afford them don't care. Here's the calculation. If you're spending $3,000 a year on status clothing and fast fashion, that's $3,000 that could be invested. Over 30 years, at 7%, that's $300,000. You're literally wearing your retirement fund. And for what? To impress strangers who will forget what you wore 5 minutes after they see you. The alternative is simple. Buy quality basics that fit well and last for years. Ignore trends. Ignore brands. Buy clothes that are functional and durable. You'll spend a fraction of what you currently spend. You'll look just as good, and you'll have hundreds of thousands of dollars more for actual investments. The fundamental principle underlying all six of these categories is the same. You're making emotional purchases instead of rational ones. You're optimizing for short-term feelings instead of long-term value. You're following social signals instead of mathematical reality. And every time you do this, you're sacrificing your future for your present. Now, I want to be clear about something. I'm not saying you should never spend money on things you enjoy. I'm not advocating for some kind of extreme minimalism where you live in a cave and eat rice and beans every meal. What I'm saying is that you need to be honest about the trade-offs. Every purchase you make is a choice between consumption now and wealth later. And if you're making that choice consciously, if you're saying, I understand, I'm giving up X amount of future wealth for this experience or this item, and that's a trade I'm willing to make, then fine, that's your decision. But most people aren't making that choice consciously. They're not running the numbers. They're not calculating the compound impact over 30 years. They're just buying things because everyone else is buying them, because they feel good in the moment, because they've been marketed to effectively. They're sleepwalking through their financial lives, and they wake up at 60 years old wondering why they have no savings, despite earning good money their entire careers. The mathematics of wealth creation are not complicated. Spend less than you earn, invest the difference in assets that appreciate, let compound returns do the heavy lifting. Repeat for 30 to 40 years. That's it. There's no secret. There's no trick. It's just discipline and time. But the problem is that discipline is hard, and time is long, and there are 1,000 temptations every single day trying to separate you from your money. Every one of these six categories, luxury cars, oversized houses, convenience purchases, trendy gadgets, lottery tickets, and status clothing, they're all designed to exploit your emotional weaknesses. They're designed to make you feel inadequate if you don't have them. They're designed to make you believe that these purchases will make you happy or successful or impressive. But they won't. They'll just make you poor. The people who build real wealth, the people who achieve financial independence, who have the freedom to do what they want with their time, they're the ones who resisted these temptations. They're the ones who made boring, rational, mathematically sound decisions year after year after year. They drove older cars. They lived in modest houses. They made their own coffee. They kept their phones for 5 years. They never bought lottery tickets. They wore the same clothes until they wore out. And they invested the difference. And here's what's interesting. Once you build real wealth, Once you have financial security, these purchases become even less appealing. When you have several $1,000,000 invested in generating passive income, you don't need a luxury car to feel successful. You already are successful. The car doesn't add anything. When you have true financial freedom, you don't need status clothing to signal wealth. Your bank account signals wealth. The irony is that the people who can most afford these things are the people who least want them because they understand the mathematics. They know what these purchases really cost. So here's what I want you to do. I want you to look at your spending over the last year, go through your bank statements and credit card bills, add up how much you spent in these 6 categories, then take that number and multiply it by 16. That's approximately what that money would be worth in 30 years if you invested it instead. That's what your daily coffee, your luxury car payment, your fast fashion habit is really costing you. Not the price on the tag, the opportunity cost of what that money could become. And then I want you to make a decision. Are these purchases worth the trade-off? Are they worth giving up hundreds of thousands or even millions of dollars over your lifetime? Maybe some of them are. Maybe there are things you buy that genuinely make your life significantly better, that provide utility that justifies the cost. But I guarantee you that most of them don't. Most of them are just habits, just social conditioning, just emotional reactions to clever marketing. The path to wealth is not complicated, but it requires you to think differently than most people. It requires you to make decisions based on mathematics rather than emotions. It requires you to resist social pressure and marketing and your own impulses. It requires discipline. And for most people, that's too hard. They'd rather feel good today than be wealthy tomorrow. They'd rather fit in than stand out. They'd rather follow the herd than think independently. But if you're watching this video, if you've made it this far, then you're probably not most people. You're probably someone who's willing to question conventional wisdom, someone who's willing to run the numbers, someone who's willing to make short-term sacrifices for long-term gains. And if that's you, if you're willing to apply these principles, then you will build wealth. Not might, will, because the mathematics guarantee it. Before we finish, I want you to do something. Leave a comment below telling me which of these 6 categories has cost you the most money and what specific step you're going to take this week to stop bleeding money in that area. I want to know how you're going to apply this to your life. Are you going to sell your luxury car and buy something practical? Are you going to move